Dividend investing, the ultimate guide for beginners. One of the finest investment methods is to buy stocks in firms that generate high dividends. Some could even call dividend investment boring, since you're investing in more established corporations for regular, dependable payouts. But consistent gains are never boring. Earlier generations of investors favored dividend investment. And although those earlier generations usually enjoyed more significant returns than are available now, dividend investing still has several advantages. In this video, we will be discussing the ultimate guide for beginners in dividend investing. So make sure to watch this video till the end and hit the like and subscribe buttons so we keep on making these videos. What are dividends? Publicly traded companies can use profits to invest in research and development, save money, or return profits to shareholders as dividend payments. Dividend income, similar to interest from a bank, is a safe way for investors to grow their nest egg. An investing strategy based on dividend income can be essential to a saver's portfolio, especially when turning lifelong investments into a retirement paycheck. However, before investing in dividend income, there are advantages and disadvantages. Dividends are never guaranteed and can be changed at will. Larger, mature companies are more likely to pay out dividends. In contrast, smaller, less established companies are more likely to reinvest earnings and experience high price appreciation rates, making them another way to grow wealth. How to invest in dividend stocks. Investing in dividend stocks is a long-term strategy that provides consistent income. Still, stock prices can fluctuate in the short term. To invest in dividend stocks, avoid making decisions based on short-term market movements. It is advisable to search for companies with consistent and increasing dividend payments, using stock screeners to review their history. The dividend yield is a crucial metric for understanding dividend stocks, calculated by dividing the annual dividend per share by the stock's price. Compare dividend yields of different stores within the same industry to identify those with higher yields. However, be cautious of excessively high yields, as they may indicate potential risks or issues with the company. Dividend investing in long-term portfolios. Dividend investing is common among stockholders, with 77% of S&P 500 stocks paying dividends. The S&P 500s present dividend yield shares at 1.60%, but there are better options available. The annual yield ranged between 3% and 5% in the 20th century. However, dividend yields have decreased due to modest savings account rates, bond yields, and the growing importance of tech companies in the industry. Tech companies invest in new products for fast growth rather than sending cash to shareholders. How dividend reinvestment boosts your returns. Dividends are a crucial factor in boosting investing returns. Reinvesting dividend payments to buy more shares of stock in your investments benefits from enhanced compounding effects. Each dividend entitles you to more dividend payments in the future, supercharging your investment returns. For example, if you had invested in an S&P 500 index fund in January 2000 and held it until September 2020, your average annualized return would be 4.2%, with a cumulative return of 136%. If you reinvested all dividend payments back into the fund over the same period, your annualized return would be 6.2%, resulting in a cumulative return of 247%. Reinvesting dividends nearly doubles your gains. For example, if you invested $10,000 in an S&P 500 index fund in 1990, you would have about $91,300 today based on price gains alone. You'd have nearly doubled that amount, or $180,000, in addition to dividend reinvestments. How is dividend income taxed? There are two types of dividends for tax purposes: ordinary and qualified. Ordinary dividends are the most common types of dividend, paid out of a company's earnings and subject to your marginal income tax rate. They can be received from investments like stocks, mutual funds, or real estate investment trusts. Ordinary dividends are taxable in the year they are received and reported as income on your tax return. Qualified dividends must be paid by a U.S. or qualified foreign corporation and are subject to long-term capital gains tax rates. To qualify, you must meet the holding period requirement, which means holding the stock for at least 61 days in 121 days, starting 60 days before the ex-dividend date. How to evaluate dividend stocks. Dividend yield is a crucial factor in selecting the best dividend-paying stocks. However, relying solely on the highest dividend yield can be misleading. A company with a declining share price may face issues, and its board may need to reconsider the dividend. Reliability is essential when choosing dividend-paying stocks. To find reliable stocks, consider the dividend aristocrats, who have historically increased dividend payments. Certain sectors, like real estate and utilities, may also pay higher dividends on average. The dividend payout ratio is another measure of good dividend stocks. It compares a company's earnings to its dividend payment per share. A payout ratio of 50% indicates a company's ability to generate reliable returns in a mature industry. Lower payout ratios indicate more sustainable dividends, while a ratio over 100% suggests that a company returns more money to shareholders than it earns. A steadily rising payout ratio could indicate a company is healthy and generating reliable returns in a mature industry. How you can pursue dividend investing. To generate income with dividend investing, consider 3 strategies: aiming for high dividend yields, choosing high dividend growth, and continuing dividend capture. High dividend yields are ideal for slow-growing, established companies with high cash flow. Still, they may yield less growth in stock value than other companies with lower yields. Choosing companies with high dividend growth allows investors to buy stock in companies growing quickly but currently paying lower than average dividends, which may yield less income in the short term. This strategy is a cheaper cost on yield and a better long-term investment strategy. Dividend capture is a more active approach to harvesting dividend income, allowing investors to buy stocks before the dividend is paid out and then sell them again after the dividend is paid. However, this is more challenging than it sounds, as shareholders must own a stock before the ex-dividend date, typically 2 weeks before the dividend is paid. After the dividend is paid, selling shares can be complicated and risky due to volatile share prices. Share price declines can wipe out the money earned from the dividend, and even if shares increase in value, dividend capture can generate short-term capital gains taxed at the higher regular income rate. Risks of dividend investing. Dividend investing involves risk, as dividends are never guaranteed and can be reduced or eliminated by companies. During the COVID-19 pandemic, prominent stocks like Wells Fargo, Dick's Sporting Goods, Carnival, Goodyear Tire and Rubber, HSBC, Airbus, and Rolls-Royce face this issue. Diversification is crucial for investors, as focusing too much on dividends may overlook sectors and classes that require good diversification. This can expose investors to increased volatility and cause them to miss out on high-value growth in sectors that may not pay or have uncompetitive dividends. Dividend investing can be both fun and profitable. While there is much to consider, taking the first step may open the door to future financial freedom. Go forth, learn, earn, and enjoy the rewards.